Good morning, everyone. It's a great pleasure and honor for me to chair this very distinguished panel, which has a distinguishing feature. I was looking at the program, and this is the only panel in which we will hear outsiders, very informed, very well-informed outsiders, looking in and telling us what they think about the Basel Committee. We have with us some very, very distinguished scholars, I would say from different generations, but I'm sure you're familiar with all of them. They have one thing in common. They have all been, they have either written or are in the process of writing the history of the Basel Committee. So let me start, first of all, by introducing the presenters. Who are in the process of writing the history of Basel II, and this is what we will be hearing about. And I will introduce them in the order of seniority. Harold James, who, among other things, is Professor of European Studies at Princeton and Professor of History and International Affairs at the Woodrow Wilson School. He's written a Herculean, I would say, number of books on economic history, spanning various centuries, countries, and institutions, and he's also the official historian of the IMF. Stefano Ugolini, to his left, he's professor of economics at Toulouse University. He's written extensively in the area of monetary and financial history, and if you haven't read it, I would highly recommend his book, his very insightful book, entitled The Evolution of Central Banking, Theory and Practice. I learned a lot from it. And last but not least, the discussant, I feel like saying the evergreen Charles Goodhart, who's the author of the History of Basel I. He's Emeritus Professor of Banking and Finance at the LSE. And of course, he's one of the world's luminaries in monetary economics and central banking. And I still remember how I was reading his books when I was an undergraduate, and particularly one, I think it was called Money, Information, and Uncertainty, which I remember not just because the font was extremely small, but because it was really very, very enriching. I very much treasured our professional relationship, especially once I started working here at the BIS. But without further ado, we don't have much time. Let me turn to the presenters who will tell us how we should think about Basel II. And I think we will hear about original sin, but this is a different type from the original sin in international finance. So, Harold.
So thank you so much, Claudio. It's really a great honor to be here. I'm delighted to be here on such a wonderful panel after such a great beginning of the day. And obviously, it's also a great event to be celebrating a 50th birthday party here. And it strikes me that there's something about 50th birthday parties that invite a breakdown of the life into various stages. And fortunately here, you have Roman numerals for the stages. So you have 1, 2, and 3. And Charles has written elegantly about 1. So 1 is the kind of early stage when infants are delightful. And they're, in a way, they simplify things, but in an intelligent way. 2 is the troubled teenager years. And 3, you've heard this morning, is the period when you settle down and you really get wise and things get better. Or, I can also think of it as a kind of musical episode in which you start off with 3-movement concerto, where you start off with an allegro moderato, and then the second phase is usually a slower movement, and it took a long, long time to produce Basel II. So that's the adagio phase. And then you get into the whatever you like to think of it, the Allegro Furioso of Basel III. Or, another way, I mean, if you want a different literary metaphor, you can think in Basel II that what we're dealing with, and we're writing the successor volume to Charles's Basel I, but in Basel II, there's something sinister at the end of it. So you remember when people used to do productions of Claude de la Close's Liaison Dangereuse, there was a guillotine at the end, or sometimes people show the marriage of Figaro with the guillotine at the end. Anyway, that's what we're dealing with. So that's the nature of the project, the dangerous phase. We've written a longer paper, and that's obviously a sketch for the book that will eventually result. And we're going to go over that briefly now this morning. First of all, thinking about the political and financial environment that produced Basel II, then the intellectual revolution that Stefano is going to talk about in the implementation, and what the problems were. I mean, why the guillotine is lurking at the end of all of this. So the international context, I think, is worth sketching out. That the 1990s are a very, very exciting period because, in one sense, there's a completely new geopolitical framework after the end of the Cold War. There's an enormous, also technical background because the computing capacity is advancing and it allows some of the methodologies that Stefano is going to talk about to develop. But it's also a moment when there was considerable banking uncertainty, and I think that's part of the background to this discussion. So just three different kinds of that uncertainty at the beginning of the 1990s. BCCI, the collapse of BCCI, Bank of Credit and Commerce International, in 1991, looks at first like a kind of really bizarre outlier, and people probably don't take it seriously enough as a warning for the whole of the international system. But in some ways it really is, because it raises the question of supervisory coordination between the Bank of England and the Luxembourg authority and the Swiss authority. And that coordination, and people talked at that stage even of a college of supervisors, so that phrase is begun then. But this was obviously lacking, and BCCI failed. Then there are big banking crises in the early 1990s, but they look as if they're domestic and connected mostly with real estate, but a reaction to monetary policy decisions as well. And then I think most significantly, the Mexican crisis at the end of 1994 puts a new set of problems. And you can see it, I think, in terms of the surge of financial flows that took place in the middle of the 1990s. And the consequence is that what I think was quite quickly described as the first financial crisis of the 21st century by Michel Camdessus, the managing director of the IMF. The first financial crisis of the 21st century, very different to the old types of crises, and pushed at a really sophisticated level, but at a high political level as well, for regulation. And so in the G7 declarations after Mexico, first in Halifax in the summer of 1995 and then in Lyon the next year, there's a call for cooperation among regulatory and supervisory authorities. And the question is then, who should do that? And that, I think, is also an interesting issue, because there are two possible variants of that, and Charles discusses this in his book as well. One is that this should be classically an area where the International Monetary Fund should be involved, because it's a global issue and it's about global capital flows. And then the other one is that this is a banking supervision issue, and this institution has the expertise for that, and so this is where it should be done. And in practice, what happens is that there's a kind of marrying of the two, but in a slightly unsatisfactory way, in the sense that the assessments and the regulations that are produced by the BCBS are going to be used by the fund in a new process of having the FSAPs across different countries. But the FSAPs are very peculiar in the sense that they're not at first applied to the big industrial countries. So there aren't FSAPs for the United States or the UK at the beginning, but they're treated as the business of the countries at the margin, where after all it looks in the 1990s as if the turbulence is occurring. And Stefano is now going to take you through the risk revolution.
Thank you. Actually, we think that the intellectual environment was very important to the development of the framework behind Basel II. And I wouldn't go as far as John Maynard Keynes that would say that actually practical men were slaves also defunct economists. But of course, I mean, the ideas matters also for regulators at the time. So I think we can legitimately talk about risk revolution in the 90s. Of course, I mean, risk management was not invented as such in the 1990s, and probability theory was first emerged in the 17th century. It was adopted since the 18th century in financial markets, especially to compute a premium for life insurance and annuities. But for a long time, actually, it was really the exogenous risk, the mortality risk, for example, in life insurance that was used in order to compute the premium. And this is really shifting with, first with Markowitz model, because one of the, this model has been enormously influential, and one of the peculiarity of this model is that it is very tractable because it collapses all dimension of risk to one only dimension, that is the return variance. And that is the first step toward this risk revolution. The second important step is, of course, the contribution of Black, Scholes, and Merton on their models for the optimal pricing of options. And at that time, actually, the so-called second Chicago school is really saying that, of course, even if the probability of occurrence of some events is not always knowable, actually this problem, it is just only a problem of knowability. The risk continues to be exogenous, okay? So once you recognize that the problem is just a problem of knowability, you can classify uncertainty as ambiguity, and you can mobilize the risk management framework in order to analyze the whole, what's going on for a financial intermediary. And these models were extremely successful at the very beginning, and even actually people realized that in the very first years following the introduction of these, for example, of the Black and Scholes price and option, actually the assumptions of the price behavior that were behind this model were becoming even truer, more and more true, because there was an issue with the performativity of these models. Actually, like the covered interest rate parity or Gordon and Shapiro dividend model, actually, once they started to be used, of course, they started to become more true. This is some sort of version of Goodhart's law in a sense. So in the 1990s, we really have a moment where the risk management starts to be seen as a sort of all-encompassing framework for all kinds of intermediaries. And there is this new shift to a new regulatory philosophy called enforced self-regulation, also based on the advances of incentives theory. And so internal audit and risk management comes to be seen as the very same thing, which was not the case before. So this is really a general movement that it goes well beyond the financial system, and of course regulators in that time comes to be very sensitive to this. And you have a quotation from a book that was published by the Bank of England in 1997, when it is said explicitly that the main responsibility for risk control has to be shifted back towards internal management and away from external regulators. And actually we can identify three important steps that are leading to Basel II. The first one is the shift to the internal models approach, which is the most famous and the most controversial one. And actually, contrary to what has sometimes been suggested in the literature, the use of these internal models for risk management was not so advanced after all at the moment when the Basel Committee decides to engage with them. They had been developed by JP Morgan internally, and JP Morgan actually played an active role in trying to make this actually some sort of gold standard for the whole industry. In 1994, they released freely actually the software for allowing everyone to compute the risk metrics for their own portfolio. So there is an active push from the industry that is defending this. At this time, at the time when the Basel Committee had tried to extend the Basel I regulations to securities firms in collaboration with IOSCO, but this collaboration turns sour. And we think that actually our interpretation is there is an attempt by the Basel Committee at that time to go beyond this problem with IOSCO and to push forward this is something that is welcomed by the industry, in order to encourage, in a sense, securities firms to become universal banks, and so to become actually regulated by the Basel Committee, which was not the case before. So this is what is leading to the market system and to Basel I, that is the most controversial, probably, issue in the path to Basel II. And then a second step that is important, even if it attracted less attention, is the fact that there is a movement toward a laxer definition of regulatory capital, first with the introduction of Tier 3, and then with the press release on Innovative Capital Instrument in 1998, that is actually allowing for the inclusion of innovative instruments into Tier 1 capital rather than Tier 2. And this, of course, plays an important role in generating some bad incentives for banks to issue new forms of securities that can be now accounted as regulatory capital. And the third element in this path to Basel III is that there is indeed, at least for some regulators, there is a shift in the way systemic risk is seen. Actually, curiously, when the first G30 report on risk management practices is published in 1993, New York Fed President William McDonough, that as you all know, will become the chair of the committee later on during the Basel II negotiations, actually he commented on this and saying, okay, but we acknowledge the importance of internal risk management practices, but there is still a problem with tail risk. And so the systemic risk is very well acknowledged early on by regulators, but later on there seems to be some sort of shifting on this view. And you have here this famous quote from Alan Greenspan in 1998, who says that the management of systemic risk is properly the job of the central banks. Banks should not be required to hold capital against the possibility of overall financial breakdown. So in a sense, this attitude toward systemic risk is really shifting, at least at the Fed board at the time. To go quickly, think that, so this is the overall, I would say, context that is leading to Basel II. And the Basel II process was very much embedded into some sort of path dependence, of course, because we said this morning that actually it is impossible to design regulation from scratch. And of course, the role of Basel I was very important there because Basel I had been the result of a peculiar situation in the 1980s from a push from the US authorities, threat of Japanese competition from undercapitalized banks. And so Basel I had some characteristics, and especially the most striking characteristic of Basel I was that it was only concerned with capital requirements for the banking book, and especially for capital requirements. And if you look at the long run history of banking regulation, this is far from obvious because capital requirement had historically been a rather marginal element of banking regulation with respect to other tools. And here they became basically the only important element of Basel I. And in a sense, we use this word that Claudio was mentioning of original sin. That was, in a sense, the original sin of the Basel process to be only focused on capital requirements since the beginning. And so the Basel I created problem because it created incentive for universal banks to move business to the trading book. And so this generated actually scope for the market risk amendment, whose main goal was to try to cover the trading book. But in turn, the adoption of market risk amendment created an incentive for securitization, for moving business to the trading, to transform bank loans into marketable securities. And so this called for an extension of the market risk amendment to the banking book. And this was the origin of the Basel II framework, this tried to extension to the banking book. And of course, this generated a lot of problem, and in the end, a fragilization of the process, because this was seen by many, by some parts of the industries and by some politicians as an incentive to bank concentration. Okay? And the Basel II process was characterized by was met by a lot of criticism since the publication of the first consultative paper in 1999. Unusually, this criticism came from inside the BIS, because Andrew Crockett, who was the general manager of the BIS, started to challenge these very discreetly at the beginning, and then this became louder after a moment. The problem of the implicit assumption of the exogeneity of financial risk was pointed, and also by academics, and most notably by the LSE group, to which Charles was part. But there were also challenges from the industry, especially complaints about the treatment of the operational risk, which was a novelty of Basel II, and also political backlash for this implicit incentive to bank concentration. And the result was the framework took a lot of time to be completed, and it was only adopted post-mortem, especially in the US, much later. And last point that I think is important and was less seen by critics at the time, but with hindsight, actually, it became very important, was that this monodimensional vision of risk, which was embedded into these risk management models, became oblivious of the specificities of banking regulation, and especially the question of liquidity risk, which was totally collapsed to solvency risk in that intellectual framework. And Stefan Engwest was saying this morning the question of the leverage ratio, because, of course, capital requirement had become, in a sense, almost meaningless thanks to the various adjustments that could be done. And so this shortcoming would be corrected, actually, after 3. So to conclude very quickly, if you
Yeah, I mean, really just one sentence. That is that it looks in the intellectual revolution that Stefano was talking about, it looks as if the regulators and banks are using the same models, and so they're going hand in hand or step by step. But in fact, they should really have been thinking about very different things, because the banks are using these models in order to improve their returns, and they're not thinking about the question of who absorbs the ultimate risk in the system, and that should really have been the task of the regulators. And thank you.
Thank you. Thank you so much. Charles, the floor is yours.
I'd like to start by congratulating Harold and Stefano, first of all, on getting almost all their 15 slides into the relatively short space of time that they had in front of them. And secondly, for making an excellent start on their book. But I think that their work so far really relates more to the external context in which the BCBS found itself. And they have as yet, I think, to go through the internal reports and work of the BCBS to see how it reacted and responded to such external pressures. One point that I would make is that I think that perhaps they exaggerate the extent of the conflict between the IMF and the BCBS. The IMF never intended or expected to take over the regulatory and supervisory work on the rich advanced economies. What the IMF was pointing out was that the BCBS was at that time doing very little about the financial stability of the rest of the less developed world. And in fact, that process generated an incentive for the BCBS effectively to expand, as taken forward by my friend and colleague Andrew Crockett at the BIS more generally, to widen the extent, countrywide extent of the BCBS. And indeed, it was the incentive to produce the core principles, which we're going to discuss again tomorrow. I do think that they've got a slightly easier task than I had, partly because I personally knew most of the people involved in setting up the BCBS, like George Blunden and Peter Cook, and also partly because I chose my closing date rather carefully, being a date which Harold very kindly said that this was delightful infants. It was a period in which I thought that it was very difficult to criticize the BCBS in any way, and I didn't want to do so in my history. So that was a natural closing date. But Harold and Stefano are going to have to cover periods in which the BCBS has come into much more criticism, and that's a much more difficult task for a historian. If you're discussing an institution and criticizing the institution which you're discussing requires great tact and sensitivity, which I'm sure, knowing Harold and Stefano, they will have in spades. I think I'd like to end just by commenting on effectively some of those criticisms, one of which I will actually defend, which was mentioned by Stefan Ingves earlier this morning, which is the criticism that the BCBS concentrates unduly on capital to the expense of other requirements such as liquidity. Let me try and take you back in history. When I was younger, in the early 1960s, the only requirements in the UK were liquidity requirements, a cash requirement and a liquidity ratio. There was no capital requirement at all. About 10 years later, there was a capital requirement and very little concern with either a cash ratio, which had actually been window dressed out of sight, or the liquidity ratio. Now, why did this change come about? And the answer is that during these years, the internationalization of the financial system led to the development of huge, very efficient wholesale markets, starting with the euro-dollar market. Effectively, that meant that if a bank was known to be solvent, it could always borrow in one of these large markets, so liquidity was never a problem. And to some extent, that remains the case today. One of the issues that raises is that the budget requirement only lend to liquidity, but illiquid, but insolvent, but not, and so illiquid, but solvent banks is not really valid, because you're only illiquid because you are potentially insolvent. So you've got to aim off for the budget criticism. There are two areas that you need to worry about liquidity, one of which is when the markets are non-functioning, so you can't borrow in a market, and that's important. But the other one, which is new, is that the speed of runs is now vastly greater. And one of the ideas about sort of not having uninsured creditors is that they warn you that something is wrong. The problem now is that with social media, the run can take place within a day. And having enough liquidity to handle runs for 30 days is completely out of date. You've got to try and deal with this occurring in 1 day or 2 days, as SVB actually indicated. Now, how are you going to do that? I think one of the ways, for example, that you need to think about is having a limit on the extent of withdrawals of uninsured depositors. That's one of the criticisms that I do not, in fact, share. Let me just end with two criticisms, if I could, quickly. One is, why on earth was there so much concern with credit risk and so little concern with market risk? I don't know the answer to that one. I've always worried it was political pressure to ensure that sovereigns could always borrow. If so, why did the BCBS not rise to, they were supposed to be independent. Why didn't they rise to the challenge? The second concern really relates to one of the points that were put up in the slide by Stefano, which was the view that risk management should be entirely done by forcing all or encouraging all banks to come to the same standards as the best bank. And that if every bank followed JP Morgan's risk metrics and VAR, the world would be all right. And I think that was a categorical mistake, because as Harold said in his final comment, the incentives of the BCBS and the incentives of the banks are totally and entirely different. The BCBS wants to minimize the total loss from a banking crisis. The banks want to maximize their return on equity. And remember, they have limited liability. That's a textbook example of moral hazard. And that effectively means that when you raise the regulations, it is going to reduce, in their view, the ability to maximize their return on equity. So they will manipulate any regulation that you try to introduce in various ways, accounting, and the reliance on internal models just won't work. And it hasn't worked, and you know that it hasn't worked. And the question then is, sort of, what are you going to do instead of relying on the commercial bank's own risk models?
Thank you so much, Charles. Harold, Stefano, would you like to respond? Particularly, I think particularly this question of, the different types of criticism of Basel II. One was that it was focusing on very much on individual institutions and so on, as opposed to systemic risk. The other were capital versus liquidity. So these are rather different. So I just wonder what you think about it.
I mean, just very, very briefly on the liquidity solvency one, which is in a way a classic issue that goes right back to Bagehot, and we've both been thinking about Bagehot for a long, long time, and Charles has been thinking about Bagehot for even longer. So it's actually impossible to tell when you actually come to the crunch whether an institution is solvent or not. And so classically, we still really don't know whether Lehman was insolvent. There are books on both sides, articles on both sides, and it's not at all clear. I think we will see the same about the discussions from 2023. So, in a sense, this solvency issue, I do think is the fundamental flaw of the Basel II concept.
Okay, we are slightly over, but I think this session was a little bit squeezed, not because it was outsiders criticizing it, but Paul.
So a quick statement and then a question to you. The statement is, from my experience, a quick statement and then a question. Quick statement, in my experience, it is sometimes very easy to see whether a bank is solvent or not. It is sometimes very difficult, and it is sometimes in between. And both Charles and Harold kind of overstate how straightforward, how clean your doctrine on that, I think, is ill-judged. More importantly, a kind of question to you is Stefano articulates very clearly that there's a kind of revolution in thinking in finance that drives Basel II. But Harold very clearly and Charles very clearly articulate the problem of moral hazard in terms of systemic risk, but also the literature on moral hazard. Think of Bengt Holmström's paper, Moral Hazard in Teams. That's the early 1980s. He wins the prize much, much later. So actually, the story is more complex. It is that one revolution in economics, in finance, drives out a deeper revolution in political economy about moral hazard. And I think one of the really important questions here is, does anyone around the governor's table, or does Andrew, raise that and say, we're making a great mistake? And the quotes from the Bank of England and from Alan Greenspan are unutterably awful, because deeply wrong without any hindsight. But the quote from McDonough suggests that he's onto it. And since he's chairing the Basel Committee, how does this go off the tracks? Does Bill lose control of the process, or what? But I'd be very interested on your thoughts on that now.
Yeah, absolutely. I mean, the McDonough quote is really wonderful. It's absolutely on the point, and in the sense that this is the warning before the event. But there's such a powerful momentum, I think, and in that sense, this is also an exemplary moment for today, because I can't emphasize enough how much the 1990s is driven by the fact that there's this fantastic new computing power that's available. And we're in exactly the same moment in terms of the application. The exponential growth of AI applications is going to do exactly the same kind of story, that it's going to convince you that this is a different way of looking at risk.
I think we will have to close it here and leave the floor to Andy Haldane on the next panel. I'd like to thank the presenters and Charles for your insights. I'm sure this is just the beginning of what is going to be your book, and I'm sure everyone is really looking forward to it. Thank you so much.